Hey everyone, Douglas here, and welcome back to Applied MMT. That's right, the rebrand is complete. I'm back as well. I'm happy to be back in front of the microphone, in front of the camera. We're going to talk rebrand in just a second, but first, holy cow. Look, I took a brief hiatus. The second to last video that I posted was that this rally is back at the end of October, and whoa, I was bullish. But wow, what a rally. We have a lot to talk about market-wise. In my brief hiatus, we've seen stocks just absolutely soar. We've seen inflation continue to cool, honestly, surprising me. Everything is just better than even I was like the only bull in 2022. 2023 coming out now. Better than even I expected. This is absolutely incredible. What a run we've seen during November. So we had a big run in November. We saw inflation coming in even cooler than expected. We've seen the Fed maybe even decide to pivot. Maybe we'll take a look at that. Everything just continues to get kind of wild here. But the Fed may be looking at cuts. We'll talk about that. We have a lot to cover in tonight's video. But like I said, I've done the rebrand to Applied MMT. I've teamed up with the guys at Applied MMT. They used to run the Applied MMT podcast. Listen, I love MMT, and I think there is still an underserved voice for what we're just calling Applied MMT, which is really just MMT applied to markets, to finance, to macroeconomics. MMT gained popularity in 2020, in 2019, in 2021, mainly because of the political proposals, the policy proposals around MMT, right? That MMT was used to justify that those political and policy proposals were viable. I'm fine with all of that, but my passion has always been with markets, with finance, with macroeconomics, using MMT to understand the macroeconomic world around us, and if we can, take advantage of markets with that MMT lens, being able to kind of exploit what the rest of the markets don't know. That's my passion. That's the passion of the Applied MMT guys. I love that name. That's what we're going to do. That's what we're going to call ourselves going forward. So from now on, we are Applied MMT. And like I said, we'll take a look at the site, everything I got going on there in a little while. But I know what you're here for. You want to know what the heck is going on with markets. What a run. So we're going to start off with one of the tools that I'm actually building for the Applied MMT website that, again, is live, appliedmmt.com. You can check it out right now. Again, we'll look at some of the features on that site in just a second. But one of the things when we teamed up that the guys at Applied MMT wanted to see is some sort of tool that can help us compare where flows are at. The underlying flow, of course, if you're here, you're well aware that underlying fiscal flow, right, the government spending is really one of the main core drivers of adding net financial assets to the private sector, and then also driving economic activity and driving markets as a whole. Is there a way to compare where we are at, say, this year, recently, to the historical trend of flows? And we're building on a couple tool ideas. This is one of them that's been in the works, and I think it does a very good job to explain really what's taken place over the last few months. And that is that back in October, we had a major drain that is just not part of the norm. So on the left here is the normal 10-day historical average of fiscal flows. This would be ultimately in billions, or I guess hundreds of thousands to round up to billion, or millions to round up to billions. But either way, this is the average amount per day on the left here. So we're looking at, during mid-October, historically, we're at 2 billion a day in the second half of October. Of course, this year, because of that big tax drain that happened on the 16th of October, because of the delayed taxes from California, we ended up seeing a window. And again, now we're looking at the right side. This is this year for that 10-day average, a drawdown, a drain during that same time period in October. There's the normal September drain that historically, seasonally, kick stocks slightly lower in September and October, but we had that second wave in October that gave us that kind of what ended up being the third wave of selling into the end of October. And then lo and behold, right at the end of October, we bottom out, and November starts off with a tear, and we end up seeing flows extremely strong in November. So we see this big kind of mispricing to the downside in October, and now November making up in very, very quick order as flows come back on in full strength. strength. Now, overall, this is exactly what we expected this year. This higher interest rates, more additional interest income, now totaling like almost $1.5 trillion this year of additional interest income from where we would have been at had rates been at zero. It's just an incredible amount of stimulus, effectively. And because inflation is falling, we know that that money is trickling down, albeit regressively, trickling down into the real economy, and production is somehow being supported by that additional interest income. It is truly juicing the markets. It's not what I would want from a policy perspective per se, but it's what we've got. And because of that, we can be relatively confident that that additional interest income is going to continue to add those net financial assets, which is going to continue to prop up economic activity and prop up asset prices as a whole. So what this tool is telling us is it explains very nicely what the heck happened in October, why we got that second wave of volatility in late October, and then why we found such a bullish resumption in November. Something I do want to point out here, again, looking at the kind of seasonal historical trend for flows, is we are going to hit a bit of an inflection point. There's going to be a tax drain December 15th, and then from December 15th into the end of the year, we are generally on a 10-day average drain, right? So flows really kind of come to an abrupt end heading into the end of the year, a soft restart at the start of next year, and then another tax period, another drain period in the second half of January before flows get very strong February into March. What does this mean? Just watch out for December 15th, right? We've seen this incredible run. Things might get a little dicey as we kind of hit this overhead resistance at 4,600, but certainly December 15th will be a bit of an inflection point. You have options expiration on December 15th, and then that's the inflection point for flows. That is one day that I'm keeping an eye on right now, especially if we continue to drift higher or sideways, kind of consolidate at this 4,600 level as we head into December 15th. So keep that in the back of your mind as a potential spot for the current rally that we're seeing to go ahead and pause. Next up, I just want to talk about what the heck is going on with the Fed and interest rates and everything. Again, from an MMT perspective, okay, first things first, higher interest rates, as we've seen in 2023, are not tightening or not restrictive policy. They're expansionary policy. It's adding more income to the private sector. Higher interest rates means more income to the private sector. It also makes things more expensive. It speeds up the velocity of money. That is all expansionary. Okay, if 2023 hasn't dissolved you of the idiocy of the current understanding of interest rate policy, I don't know what's going to do it. I've been hammering. Look, I understand in 2022 why you thought I might have been crazy, right? That I was the only one that understood that this whole interest rate thing is backwards. I was right. Everyone else was wrong. I'm no longer the crazy one. They are the crazy one. And if you're here and you can't accept that at this point, I don't know what to tell you. But if it's obvious to you now that they had the levers backwards, higher interest rates juice things, lower interest rates dampen things, then it makes what we're seeing right now with the Fed rate decision, what the market wants the Fed to do, it's twisting my brain. It's kind of mind-boggling because here's the thing. The Fed, above all else, first things first, the Fed is the monopoly price setter of interest rates. If they want interest rates at zero, they can keep them at zero. If they want them at 5% indefinitely, they can keep it at 5%. It's crazy to me that, one, the Fed doesn't even realize that they're the monopoly price setter for interest rates. Two, it's crazy to me that they have the levers wrong. Three, it's equally crazy. So now we're triple crazy here, that instead of just making policy based on the way that they think policy should be for whatever outcome they think they need, that they actually look to the market to tell them what to do. And this is kind of the crux of what is getting a little wild here, is right now, at least for the December rate hike meeting, which is going to happen in just under 12 days here, we're not looking for a change. So it's unlikely that the Fed is going to come out and make any rate changes. But if we look forward to March of 2024, just a couple months away here, just a few months away, right now, the odds are that we are going to get a rate cut. And this is fascinating. Now, I don't think a 25 basis point rate cut one time is going to take us off the current trend that we're at. But if this becomes a trend, if the Fed starts cutting rates more and more and more, lower rates are disinflationary, right? So it could disrupt, to a certain extent, the current momentum that we've seen. And a lot of the momentum that we've seen through 2023 has been because of that additional interest income from higher rates. Again, I am not calling for some sort of top the minute the Fed starts cutting rates. In fact, I bet when they start to cut rates, the market will do exactly the opposite of what they did in 2022 when rates really started to take off, is that the market will effectively reprice to the upside to undo the repricing that occurred to the downside when it was very apparent that the Fed was going to get very aggressive in the rate hike cycle. So I think we could see a reversal play out. We also have a lot of capacity for the banking sector right now to expand their balance sheet space. So we would see certainly at least a 12-month cycle from the bank side of things that would prop equity markets and growth higher. But it could be a turning point that we would look back at that would kind of shift from this fiscal dominated stance that we've seen over the last year plus to an endogenous bank credit cycle ran growth expansion that we would see in that endogenous cycle. If fiscal pulls away, is not self-sustaining. It's a real cycle. It will reach a peak, and you'll have a Minsky moment, and then you'll have a business cycle recession that could get very, very bad if and when that finally occurs. Again, that's way down in the future, but we could look back at a March rate cut as the beginning of that potential process. In the meantime, though, we have a lot before that happens. We're going to have a lot of data come out. Obviously, we're going to have a few CPI prints, a few job prints that come out until that point, until March, the March Fed meeting. But as of right now, the market is starting to tell the Fed, we want rate cuts. Again, it's wild because the market has it backwards, the Fed has it backwards. The Fed should just be setting its policy to meet whatever it thinks it needs to meet based on its own charge. They're looking at the market. It's convoluted. I think if the Fed ultimately cuts in March next year and they start down a cutting path because inflation is starting to drop sufficient for them, I think we could see this as an inflection point. Particularly, the inflection point would be where the endogenous money cycle, that credit cycle, starts to kick in and kind of take over as the dominant feature in growth. So keep that in mind. All right, we've made it this far. I know what you're thinking. What are you doing over on Applied MMT? What's happening over there? Well, you can check out the site right now. Like I said, head on over to appliedmmt.com. Now, my old Patreon feed used to just be my updates. What the Applied MMT guys are adding are actual written articles. They're going to supply much more of kind of that micro narrative where the macro applied MMT stuff meets kind of that more macro understanding. So they're going to be writing up some articles. I'm going to continue to do the video updates that I've always done. We're going to, if you like the podcast version of what we do, we have a monthly outlook that is effectively the podcast that we're doing, but an extended, more targeted, more actionable idea version of those podcasts. So that's all there. And of course, all the dashboard tools that I've put together over the years and some of the new tools that we're working on, such as the heat map, are going to be added to the Applied MMT site, like already the Deep MMT tool, which when I put this thing together, listen, I just a little victory lap here. When I put this thing together, I knew it was going to be neat, right? The underlying structure, the underlying core of the Deep MMT model, the actual deep learning algorithm that was developed, I knew it was powerful, but holy cow, this thing has been on fire. Just to show you, and if you're not following me on Twitter, you got to follow me on Twitter. August 17th. All right, this is date stamped. You can see it in my timeline. It's date stamped. Scroll on down. Here's the call for what was going to play out in October through November, all the way back. Again, August 17th. I'll click on it to zoom on in. Look, the only problem with Deep MMT does get a little exaggerated from time to time. It can definitely... It needs to get reined in on its excitement, but it knew something was cooking back in August and that we were going to see a bit of a sell-off through the end of October. And then it knew that for whatever reason that we were going to take off into November. Look, is it a perfect model? No. Do I know there's some weaknesses to it that we're working on for Deep MMT2? Yes. Does it continue to surprise the heck out of me with how accurate it is? Yes. And again, if you want access to this tool and many others, I'll show you a few others in just a second here. they're all over at Applied MMT. So again, Deep MMT, a great tool to use to try and just kind of wrap your head around where the flows are at. Also the flow phase model, the Minsky flow phase model, just a great longer term model to understand where are we at flow wise. A great tool that I use every single month just to kind of, just as kind of a sanity check sort of tool. If you like the raw data itself, we have a great presentation of the daily fiscal flows. I have a handful of different tools that I put together to fully analyze that, monthly comparable charts of the DTS, daily treasury statement every single day, getting posted. This dashboard is live. Data gets updated daily. All the tools that I've ever put together that I find useful that truly kind of help me understand the market from that MMT lens, they're all up here. We continue to build out more. They are up on appliedmmt.com. So if that's something you're interested in, if it is all built for active traders, active investors. Look, it's priced for active traders, active investors, but the tools there are powerful. If you're sold on this MMT thing, I don't think you can go to any better. I don't think there's a better resource out there for tools that have been developed through an MMT lens that can really help you understand markets, and that is now all over at appliedmmt.com. All right, I think that is what I have for tonight. I'm glad to be back. It's fun. Hey, if you like this video, get subscribed. Hit the notification bell. Turn that on so you don't miss any updates going forward. Hit the thumbs up. I'm going to be back with a lot more. Trust me, you don't want to miss what's coming up very, very soon. But for now, good trading, everyone, and we'll talk to you next time. Bye-bye.